Dude, it's crazy. It's so crazy.
And now introducing the coolest, most funkiest investment group this side of the Mississippi, where real estate investing and beer come together like a Motown classic. This is Opportunity Investors. What's up, everybody? So I'm speaking into this mic, and there's no actual speakers behind me. That is because we are live streaming over here. Thank you guys for coming out. Who is here for the first time?
Nice.
Awesome.
Very cool.
Thank you
How'd you
guys
find
for
us?
joining us.
How'd you find us? Facebook? Alex? Facebook? Cool. Awesome.
Heck yeah. Awesome.
cool.
Well, welcome, guys. If you've never been here before, let me turn off Michael Jackson really quick. And Van Halen. All right, we got to pay the sound man a little more.
You didn't realize we were a roller rink.
That's the Jackson 5, yes. So yeah, guys, if you've never been here before, Opportunity Investors, it's a real estate investment group. We talk about investing strategies, financing options, and the implementation of those right here in Hampton Roads. And sometimes we talk about beyond as well.
Yeah.
But we bring in industry experts and professionals to talk about relevant subjects and just, what's happening right now, what people are asking about. Hopefully you guys actually hop on Facebook and ask questions. And then we discuss those over some cold craft beer is the idea.
Yeah.
We like beer, we like talking real estate, and that's why this kind of came together.
It stayed this way.
That's why it stayed this way, yes. So the other part is networking, and we are glad you guys are here in person. We kind of went, online for, how long was that? Like 9 months?
Almost a full year.
Almost a full year. But we were able to keep it going, and just glad to be back in person. Hopefully we can keep it going for a little while in person. So glad you guys are joining us. Glad you're joining us online, if you're joining us online. And we're here to do a little bit of learning, networking. And as we do, let's raise our glasses for a quick toast. May your castle be secure and your cup overflowing. Cheers.
Boom. John, we got to get you a
All
beer.
right.
Like, beerless. We got to get John a beer. All right. So, guys, thanks again for being here. Specifically today, we are talking about, I should be here. You're going to give that to John. We are going to talk about LLC creation. We're going to talk about why, and then we're going to talk about the tax consequences that come along with that on the CPA side. And then we're going to talk about, like, what happens if you don't do it the right way and where you go and where you end up, right? So, like, litigation side of things is where we're going to get to. So, I already talked about who was here. All right, so everybody that's online, if you would, we'd like for you to interact with us and give us questions. We're going to do some Q&A. So put those questions in there. We're going to run back through them later and answer them. And then here in person too, guys, ask, right? This is supposed to be this very laid back feeling. This, if you guys can't tell, this is not this professional setup. We're having beers, we're in flip flops, and we're enjoying.
Man. What the
yeah,
heck?
we're keeping it low key, right? Like, I don't want it to be so bougie. I want it to be real, right? And that's why we do this. So please stick with it and ask questions, okay? Don't hesitate to ask questions. But let me do some introductions here. So John Napier from Hanger Law, he's going to talk about formation and why and how. Steve Green is from Archangel Law, so he's going to talk about what happens when you don't do it the right way, right? And where you end up in litigation. And then Andrea McDonald is from Pro Tax Accounting, and she's actually in charge of our books, so I can tell you firsthand. Like, she will tell you exactly how, when, why, and where. And if you don't, she'll kick you in the ass. What you need. So that's why I hired her. So everybody up here it's just a really good panel that we want you guys to get as much information out of. So online and here in person, please, ask those questions away, and let's just dive into it. Real quick though, before we do, online, if you haven't followed us, go follow us at Hopportunity. As well as Virginia Wholesale Real Estate. Those are 2 Facebook groups to go to and find a lot of information on. You should be streaming both of those, right? And then I think we have this on YouTube as well. So let's start it. John, talk about forming LLCs, why, and why it matters.
Awesome. Thanks, Sean. Thanks, Alex. Good to be with you guys this evening. My name is John Napier, Hanger Law, as Sean said. Predominantly, why you're going to be looking at wanting to form an LLC inside of your real estate investment is really it's inside the name of what an LLC means. It's a limited liability company. You're doing that to limit your liability. I'm going to be talking a lot, hopefully in concert here with Steve, because I feel like I'm a little bit more he's a little bit more the stick, right? I'm going to encourage you to do things the right way. He's going to let you know what happens when you don't do things the right way. And I don't know, Andrea's the sugar on top. Maybe there you go. she'll help you save money through taxes. So, you're looking to limit your liability in any kind of business that you're doing, and specifically within real estate, because there are a lot of pitfalls that can happen, and a lot of elements that you want to be able to protect your own liability, your personal liability, when you're doing a real estate business. So let's just say very simply, you're doing a buy and hold, you're buying a rental property. So why you want to hold that rental property inside of an LLC is because if someone slips and falls right on that property and they want to sue the owner, they would sue the LLC if it owns it. And basically the liability is limited to whatever that LLC owns. Okay. Now, if you own it in your personal name, which you can do, I mean, that's obviously very legal to do, but if they end up suing you and you own it in your personal name, and if that person wins, their judgment against you is going to attach to everything that you own personally, right? They can go after any other property that you own, personal property, real property, bank accounts, etc. They can go collect. And so that is the main thrust of really wanting to limit your liability and say, hey, you hold real estate inside of an LLC to protect yourself and to protect your assets is a big part of that. And so inside of the formation, and I'm really, I invite anyone on the panel here to jump in. I don't know how you guys, I think we'll do questions more towards the end, but yeah. I'm very interactive too. So if I say anything that sounds weird, or if I use a word that sounds strange, or you don't even know what it means, feel free to throw your hand up, or you guys jump into. Forming an LLC in Virginia is relatively easy. The State Corporation Commission basically governs all companies in Virginia. So again, let's just say you're going to buy a quadplex, okay? You decide to form a new LLC to go buy it. You would form the entity with the state. That would give you your articles of organization. That would give you your certificate of organization. So you have an entity created with a state. And then there are documents behind that we highly, all of us have talked already, we highly encourage you and actually would insist that you would do these things just to make sure you're protecting yourself and forming the company correctly. Because ultimately what you're going to hear from Steve is if you don't form an entity, that's obviously you just have personal liability. If you do form an entity but don't run it correctly, you're still opening yourself up to personal liability. And I'll let him talk about what piercing the corporate veil is, but that is not a phrase you ever want to hear against you when you get into lawsuits or have legal issues. So the governing document for an LLC, and I'm going to talk about Virginia because I'm a Virginia licensed attorney. I'm licensed at least one other state, but we're not in that state, so we won't worry about them. But the operating agreement is what dictates how the company is run, okay? So that's a document that you put together that says who owns it. The members are the owners, and I won't get into too much nuance, but you could technically be an owner without being a member. But typically when you form an LLC, the members are the owners, and then that LLC is either member managed, so the owners manage it, or it's manager managed, which means you designate managers specifically to then run the company, okay? I will try not to be too boring or belabor this, but your operating agreement is very key. You need an operating agreement because that will dictate how the company's run. If you're a single member, meaning there's only one owner, so let's say you want to go buy your quadplex and you're the only member of the LLC, you technically do not have to have an operating agreement under Virginia law, but you should, and Andrea and both Steve will talk about why you should. If you have more than one owner, you have to have an operating agreement. You have to have something that dictates how the company's run. That operating agreement is going to say who has what powers to do what, how often you distribute your money, who is the tax matter, who oversees filing the taxes. Hopefully, if it's a good operating agreement, it designates a tax matters partner. Andrea, we'll talk about that too, hopefully, but it's going to outline how the company's run, who owns it, and how the structure goes. Okay. So you've got the operating agreement. That's key. That is absolutely key. You have a few other things. You have some subscription agreements. You have consents in lieu of the first meeting, typically, because you're usually not having an annual meeting the first time you form. And then you have an EIN, which is an employment identification number with the IRS. That's a tax ID specifically to your LLC. And then the big part of formation is when you form the company, you need to run it like a company. You can't use it as your own piggy bank. You don't want to commingle funds of your personal funds with the LLC funds. You know, you want to run it like it's an actual company, separate company, because if you ever end up in court and you don't have an operating agreement, you don't have a separate bank account, you don't have these procedures in place, and you don't have the formation correct, what they're going to do is they're going to say, this is a shell company. This is pointless. You created an LLC with a state, but it's meaningless because you're just running everything like it's your own piggy bank. You're running all the money through your own accounts. Done. Like, we're going to go after you. Like, they pierce the corporate veil and they're going after you personally. So the LLC is key. And to my knowledge, I think we're talking specifically predominantly about LLCs. There are other types of corporate entities or companies that you can form in Virginia. Corporations, there's a C Corp, there's an S Corp, there's limited partnerships, there's several other things. But LLCs are most used by real estate investors. Why? Predominantly because they're very private, okay? You've got very few things that are on public record with an LLC. You got the name of the LLC, when it was formed, the state in which it was formed, right? You have the registered agent, and the registered agent, you have to have a registered agent for an LLC in Virginia and every other state that I know of. The registered agent is the one that receives legal service on behalf of the entity, okay? So if you ever get served with a lawsuit or anything official legally, it has to be served to the registered agent. That's typically why people have attorneys as a registered agent. You don't have to. You could have your personal name on there, but just know that's public record and everyone can see it, okay? And then you have the business address, right? So you have the registered agent, their address, and then the principal office address for the LLC. That doesn't, in Virginia, that doesn't have to be in Virginia. The registered agent and the registered agent's office has to be in Virginia. The principal office of the LLC doesn't have to be in Virginia technically, but it cannot be a P.O. box in Virginia unless you're in some podunk nowhere town that, you know, no one can find. So you have to be really careful. So you can't just have a P.O. box on that. So that's all that's public. LLCs are great because the operating agreements are private documents, right, for your company. You can form them, you can reform them, you can amend them, you can update them, you can add in owners, you can take out owners as you need to. Again, you want to make sure you're doing that in the proper, right, and orderly way. But if you're doing it, it's a very private entity. It's one that limits your liability, right? It really corrals. So if you buy the quadplex, you put it in your LLC, and that LLC's got, you know, some bank account with a little bit of money, and then someone slips and falls and they sue you and you lose, that judgment is going to attach only to whatever that LLC owns. That's it. Which in my example is just the quadplex and maybe a bank account with a little bit of money potentially, right? Again, if you own it in yourself personally, if you own your car, they could attach it to your car. If you own your own personal residence, attach it to your personal residence. If you have personal bank accounts, they can go try and collect from every single bank account that you have, retirement account, etc. So it's very, very, very important to be very conscious of how you're forming your entity, making sure you're forming it right, getting right things in place. And then it's important to make sure you think through like why the liability protection is important. You will spend some money up front forming it, but I guarantee you, if you ever deal with a lawsuit and you do it right, you'll be glad that you did, because it'll be far less money than you'll lose in legal fees and or in collections later on. We got a question. Can we take a question?
Go for it.
Yeah, jump in.
So, as investors, we always see like there's two ways. The cheap way where you can just go online, pay $100, get your LLC. I heard you shake your head. My lawyer says the same thing. So, what's for us in simple language? What's the benefit of doing it through an actual lawyer versus going online, paying $100 to your
So
So let me take
before we
that
answer,
one.
Well, actually, let Sean
I'm gonna
repeat the question
repeat.
real quick.
I'm gonna repeat it for those guys online. So let's say it again. What's the reason for actually going through an attorney to do it versus doing it on your own? Right?
All right, let me take that one. A good lawyer will win for you in court. A great lawyer will keep you out of court. Okay? If I'm going to give you an example, I'm going to try to keep this really, redacted and germane, and it's in a different vein, but it kind of proves the point. I had a gentleman come to us that his father was getting Alzheimer's disease and quickly becoming to a point where he couldn't make his own decisions. He had $1.6 million sitting in a bank account to take care of him in his later years. This gentleman didn't want to have an attorney write his durable power of attorney, right? The document that allows him to make decisions for him once his father is now no longer able to make his own decisions. He went online and downloaded a form from, we all
Say
know
it.
we all
Say
know,
it.
we all know them. We all know the ones
Starts
that
with
are out there.
L, ends with Eagle Zoom.
It starts with an L and ends with Eagle Zoom.
Sounds like Zoom. Bird fly somewhere.
So he downloaded it. The problem is those things need to be customized to the very specific situation you find yourself in. The one that he ended up downloading was, this will be governed by the state of California. We're in Virginia. The state of California observes and enforces certain rights for the durable power of attorney that Virginia does not. It disallows anyway, to make a long story short, the bank looked at that and did not honor that power of attorney. They're like, we can't honor this, and they froze the account. So now dad can no longer make his own decisions. He's got $1.6 million sitting in the bank, and they can't touch it to take care of him. So now he's coming to us, $15,000 later in legal fees to litigate, to get a declaratory action to say that he has rights to that account, and he finally gets some access to that money to take care of his dad. Saved $250 up front, spent $15,000 on the back end. The same thing's true with what you're dealing with here. If you don't have an operating agreement that's tailored for you specifically that you're actually going to follow, then we'll poke holes in that. We being, if you get sued, right? We represent the person that did slip and fall. And we're going to find this operating agreement that either was downloaded or you did yourself, or we have one case now where a CPA did it for them. And we're going to find holes in those, and we're going to show that you're not observing what's called the corporate formalities. And when you don't observe the corporate formalities and you're using that LLC, and we can show that you're using that to perpetrate a fraud against the clients or to work an injustice is another term of art, you're commingling funds or you're not observing those actual formalities, we can pierce the corporate veil. And we're coming after your college account for your kids. We're coming after your bank account. We're coming after your truck. We're coming after all that stuff. Some of those corporate formalities, as you download those operating agreements, look at it, you will have an annual meeting, right? And you will give notices to all the members for that annual meeting via certified mail, not to be given any less than 90 days previous. Or do you really do that if it's like you and your wife on this LLC? I'm sorry, but now you haven't observed the corporate formalities. And I'm not saying that's positive necessarily, but we add one after another, after another, after another. You're going to find yourself personally liable.
And just for those non-lawyers out there, dispositive means specifically relevant, as in like in a holistic sense. So that's a great synopsis of why you go to your attorney or an attorney to make sure you have things squared away. Because you spend $250 to get a durable power of attorney, or you spend $15,000 going through the court to get a declaratory action that your dad is incompetent and not able to make, like, and I say incompetent is a legal term of art for saying they don't have the capacity to make their own decisions, right? Not they're an idiot, but it's a capacity issue. And so you absolutely want to make sure that things are set up correctly on the front end. And because it is a protection, right? It keeps you from getting into the place where you can lose everything, frankly. That, I don't mean to be hyperbolic about it, but that is frankly exactly what someone like Steve will do if you're on the other end of him. You don't want to be on the other end of him, right? If you're in a courtroom, because he knows how to poke holes, he knows how to get at those things and try to destroy any formalities or shell corporation that might have set up, that people just set up and ignore after the fact. So that answer your question?
Yeah.
Registered agent.
But yeah, you're registered agent, correct? Thank you very much. They'll charge you an extra fee for being a registered agent for the year, right? It's an annual fee. Is it in our best interest? You know, me, I have 5 agents, right? I don't have a full mine. Is it in my best interest to pay that extra fee to keep an actual lawyer as a registered agent rather than just keeping my box?
I'm going to answer first. I'm going to let Steve follow up.
Let Sean repeat the question.
Oh,
real
yes.
quick.
Thank you.
So that's why I'm creeping up on you. Like, here's the mic. Here's the mic. So, like picking the
Speaking to
lapel
my
off.
chest.
So the question was is it worth keeping the registered agent and paying the attorney the fee so that you can keep that anonymity, I guess is the
Separate
best
from yourself.
anonymity, like separation, right? Or is it worth the $100 to save and not do it?
Yeah, so I will say, because I form them all the time, I was literally, and I'm not exaggerating, I was drafting an operating agreement before I drove over here. It is what's that? Yeah.
I wish.
It is absolutely worth, and I know that I'm talking from an attorney's perspective, but I think it's absolutely worth having an attorney as your registered agent. Why? Because the moment anything legally gets served to that entity, it goes to your lawyer. Here's the issue, and Steve's going to expound on this. If you get served a lawsuit in Virginia, like it's a circuit court lawsuit, someone sues you and said, "Hey, I want to undo that contract. I want to enforce that contract. I want to sue you because you screwed me out of that contract." You have 21 calendar days. You have 21 calendar days to respond. And if you don't respond, that other side is automatically granted what's called a default judgment. Everything that they claimed in the lawsuit is true. The judge said they didn't respond, done. Whatever relief they asked for, done. And if that doesn't go to your attorney, the moment it's served, if it comes to you or some other entity or some weird address out there and you don't get it in time, there is severe potential severe consequences to that. So I know that from an administrative aspect and even from a cost standpoint, whether it's $100, $150, $200 a year for each entity that you have, that feels like that can add up. I get it, but you want your attorney to get served for you because they will know exactly how, at the very least, they will respond. And I'll let Steve talk about how that happens.
Yeah, so that is what's possible. Let's talk about what really happens in the courts. If I tried to file a default judgment or a motion for default judgment on the 22nd day, it's not going to get awarded. The judges are not going to do that right at 21 days. But here's the problem: they could. Okay, they could file that default judgment in our favor. But more than likely, they'd give you a couple days grace. You know, you can call the other attorney once you get it. You can work some deals out. In this area, we are encouraged to work together that way and not be quite so cutthroat. The problem is, to John's point, they could. And do you really want to run that risk? So it really comes through your personal preferences. Are you the kind of person that jumps on your mail the first time you get it? I mean, when that statement comes from the SEC, it says it's time to renew, and you're like, "Oh, I've got 2 months to answer this, to respond to it, to pay the $50 to renew it." Are you really going to renew it, or are you going to put it on the bottom of a stack of papers and get to it when you get to it? Right? If you have a registered agent, that communication is going to your registered agent. Okay. If you're getting served, there are other things to think about, and this is probably more for the storefront type of people, but it's not uncommon for the sheriffs or the high constables to be the people that serve those documents, those court papers on you. Do you want a sheriff showing up to your place of business in front of your customers and saying you've been served? Or would you rather that person show up to your attorney's office and serve them there so you maintain that level of dignity, if you will?
I have a non-attorney perspective to this because I've learned better. I was that business owner who was penny wise and pound foolish. I formed my own LLC. I didn't have an operating agreement until I let Steve write one for me a couple of years ago. And I still am, my own registered agent, which will probably change. But from a non-attorney perspective, the peace of mind for me is knowing, like, what happens now if I were to get served. I would have to take that document to him and pay him his normal hourly rate to review it, to tell me how to respond or to respond on my behalf, when I could have just paid him to be my registered agent up front. It would all be dealt with. I wouldn't have the stress and the headache. I could continue filing tax returns, which is how I make money, versus spending my time away from tax returns, researching Virginia legal statutes, which I don't understand anyway, and then I end up paying him anyhow. So it's a penny wise, pound foolish decision. I've learned the error of my ways. I was a bootstrapped business. I started with a couple of desks and $0 in the bank. But I know now that it's smarter to have the legalities dealt with up front than to try to clean up. It's the same thing I tell my tax clients. It's better if you call me before you make a purchase so we can talk through the proper way to do it than to clean it up after. So the very thing I advocate for my clients to do is not the thing I was doing in my own business. How stupid is that? Like, I know the right answer and I wasn't doing it. So from a non-attorney perspective, if you are your own registered agent, I would strongly suggest that you consider not doing that. I would pay him more money to respond to a lawsuit than I would to have him be my registered agent to begin with.
And I would take that money.
He definitely will take that money.
That's right.
For the record, he is now my attorney for everything. I don't sign a contract. I don't sign anything. I put it in front of him and I say, hey, would you sign this? If that's a yes, I'm signing it. Like, he's my all things legal for personal and business. But just from a business owner perspective, who was very bootstrapped and very cost conscious, it will, I 100% guarantee it will cost you more in the long run to do it wrong than to just do it right to begin with. Come up with the $300, $400, whatever, $600, whatever it costs. Do it right from the front. Then I won't have to hassle you on the back end when you're doing taxes. He won't have to hassle you. They won't have to hassle you on the back end when you get sued. It just, my personal.
Yeah, that's great. And I appreciate Steve was giving you the reality of the litigator's response to what I was saying is technically possible, which I really appreciate. I will also even slightly amplify what he said too, is even if you're the person that's on top of your mail and you respond to everything right away, if you go out of town for a week or 2 weeks,
Or your attorney
3
goes out of
weeks,
town for a week or 2 weeks.
Yeah. Well,
I mean, the availability of being able to even get in front of that person.
I don't allow my attorney to take vacation.
yeah.
I need
I mean,
somebody there to fix
that's
mine.
yeah. It is. There's always a cost benefit analysis and all this stuff. You really want to set up things correctly. You want to make sure you get them done right. And I highly encourage you to make sure that you're having your attorney involved from the get-go. There's another question here.
Let's do one more question. We're going to do it.
What if your attorney is on vacation for
Fire.
2 to 3 weeks, and is that their responsibility? And why don't I just make the LLC the address of the rental property so that way they serve themselves?
So your question is, if your registered agent is on vacation, is that your question?
Yeah, that's
Okay.
the question.
But I think that depends on. I mean, partially any attorney that you have. It depends on if you're doing one single attorney or if you're talking about a firm. Steve and I are with firms, and if he's on vacation or if I'm on vacation, I've got 10 other attorneys in my firm, right? Even if I'm literally am named as the registered agent for whatever reason and not the law firm, oftentimes the law firm is named as a registered agent. But regardless, if that's served, someone is there to back up. I know we've got fail safes for that kind of a situation. If you are dealing with a sole proprietor, like one attorney, one office, they have one paralegal, they're going to have to be reachable. Unfortunately, attorneys, even vacations are not vacations. And that's just the reality of our profession, unfortunately. Hopefully you guys get to take vacations. We work on vacations, and that's just the way it goes.
Well, and also I was going to say, if you have a single, a solo practitioner like that, and he or she is actually signed up as a registered agent, they would have a duty to make sure that somebody's looking at that, and they have some sort of a stopgap for that. I do want to touch one thing. You said not make the rental property address the address of the registered agent. That was a joke. Okay.
Have your
Served there. Okay. I was, for a minute there, I was like, I'm not sure if I heard that right. Yeah. Okay. So I won't.
You had Steve Ray to pounce.
Yeah.
All right, so let's get over to Andrea and let her get on there. And what we want to try to do is do about a 15-minute window for each one of y'all, so we can kind of let each one of y'all go, and then have about a 30-minute, maybe 15-minute window of question Q&A online, and then have that be where we can network later. Okay, so we're gonna put you guys on timers. Ready? Go.
So I'm not an attorney, but in true CPA fashion, I have a disclaimer. Info provided here is general info and should not be construed as tax advice applicable to your situation, right? So anytime you ask a tax question, the answer is it depends. And it's not because we're assholes, it's because it really does depend. Every person's tax situation is unique to them. And he could have.
No, because if I wrote it, I'd be like, we are
would've
trying to
been
be
way
assholes.
longer.
But.
So I'm going to give general advice and I'll answer questions in a general fashion, but for a question to be specifically applicable to you would require a one-on-one consultation. And when I talk about taxes, I'm going to talk primarily from a federal taxation standpoint. Each state has their own tax rules. So when I do answer a question about a state tax scenario, it'll be specific to Virginia because that's where we are. I do prepare taxes in every state that has income taxes, but for tonight's purpose, we're going to stick to Virginia. You may occasionally hear a curse word. You'll be all right. We're all adults here, and beer has been flowing. I'm on my second one, so it's a toss-up. So from a taxation standpoint, and I have a couple of questions because I'm curious to poll the crowd. So who here has had rental properties on their tax return, whether it was a Schedule C or Schedule E, and we'll get into what that means later. So who has rental properties that have already reported on a tax return? All right. Who has had a rental property show a loss? Highly common, right? Everyone thinks that's a terrible thing, but from a tax standpoint, we want a loss, right? We don't want to pay taxes. Who understands why that loss could or could not be deducted? Okay, so we got one or two people who understand, right? So that's a fairly complex area of tax law, talking about passive losses versus active losses, real estate professional status versus not. But in general, when you have an LLC, unless you're a multi-member LLC, so if you're a single member LLC, it's going to report on your personal tax return. It's not a separate business tax return. The business does not incur its own tax liability. An LLC, for tax purposes, not for legal purposes, but for tax purposes, is a disregarded entity, meaning the IRS considers you and your LLC the same person. Very different than on the legal side where the LLC offers you personal liability protection. Tax side, same person. Doesn't matter. You're going to report it on a Schedule C or a Schedule E depending on the kind of rental property and whether you materially participate or not. So when you are a single member LLC and it's a disregarded entity, it reports on your personal tax return. There are a whole slew of rules that determine whether you can deduct losses or not deduct losses. I literally have 3 pages of just notes I jotted down to remember to talk about. So how many of you own buy and holds? So long-term rentals. How many of you own short-term rentals, 7 days or less average stay? Okay, so there's a couple of you. Very different areas of tax law. So just for naming purposes, I'm going to say short-term rental, and when I say that, I mean the average stay is 7 days or less, so think like an Airbnb, typically 7 days or less. Don't usually have too many long-term rentals in an Airbnb, though it can happen. How many of you have wondered whether you qualify for real estate professional status or not? Right? So passive loss rules limit you to a certain amount of losses if you're not a real estate professional. How many of you own real estate and are real estate agents? A couple of you. So if you're a real estate agent and that's your full-time gig, generally you'll qualify for real estate professional status. It's everybody else who wants to know why they can't deduct those losses and how do they qualify as a real estate professional. So have you talked with a tax professional to figure out how you would qualify and why you don't qualify? So, okay, right. So if you have a full-time job, you're not going to qualify as a real estate professional. I don't care who you are and what you do. One of the rules is that you have to spend at least 50% of your time on real estate related activities. So if you have a full-time job is 2,080 hours a year, then you have to spend another 1,040 hours or more doing real estate activities. Nobody wants to work that hard. Unless you're in like the hazmat industry or, I don't know, an ER nurse or something, nobody works that many hours. I don't want to work that hard. So how many of you have consulted with a tax professional to figure out if you can qualify for real estate pro status or not? Okay. And just out of curiosity, what was the determination? You do qualify or you don't? And did they tell you why? Not to put you on the spot. Okay. Yep, so there's a couple of tests you have to meet if you want to be considered a real estate professional. We already talked about the 50% or more of your time. There's also a 750-hour rule. Now, generally when I get asked this, it's more for the short-term rental. It's like the Joe Schmo who listed an extra house they had on Airbnb and they want to know why they can't deduct all the losses or whatever. So the 750-hour rule says that you have to, in addition to all the other rules, there's like 7 tests to determine if you can be considered a real estate professional. IRS never makes anything easy, but let's cut it down to the simple 2. One of them is the 750-hour rule, and that rule says that you have to spend at least 750 hours on rental or real estate activities to be considered the real estate professional. But if you have short-term rentals like Airbnbs, so 7 days or less average stay, that doesn't count towards the 750 hours. So for example, let's say you have long-term rental properties and you spend, I don't know, 600 hours a year managing those, and you're doing what your CPA advised you to do, which is to track everything you do related to those rentals. You're tracking the time you spend mowing the grass, you're tracking the time you spend fixing the gutters, you're tracking the time, you're tracking it all. You're amazing, you're my favorite client, we definitely need to talk after this meeting. Let's say you're that person. You spent 600 hours doing that, and then you have about 200 hours a year on these short-term, less than 7 days or 7 days or less stays. So you've got a total of 800 hours in real estate activities, but the IRS says if it's 7 days or less, that doesn't count. We don't care about you. 600 hours is what you're at, so you don't meet the 750 hours rule. So when you're a real estate investor who's splitting your portfolio between long-term rentals and short-term rentals, you need to be thinking about things like that, because you could be costing yourself a lot in tax money. It could be worse. I mean, everything could always be worse.
I have a question, because so I've done short term, but I also do furnished long term.
Okay, like corporate apartments or something?
Yeah. Oh, sorry. So I've done short term, and then I've also done long term furnished, which is considered midterm. With the IRS, is 30 days or greater considered long term in that category, or what does the IRS consider long term?
So there's not really a bright line test for that. They define they don't even define short term. I use that because I'm too lazy to always say 7 days or less rentals. It just doesn't roll off the tongue as sweetly. But the IRS identifies 7 days or less as not buy and holds, and anything other than that could qualify for regular rental real estate status. So in your case, I would say typically yes. Again, don't know your specific tax situation, but yep. I don't know. Any other questions?
It depends.
Specify what is considered real estate activities. Like say you provided like a support to like real estate analysis.
Mm-hmm.
Right? This numbers from this work. Is that considered real estate time?
So
Can you repeat that real quick?
Yeah.
Well, so the question is, and correct me if I'm wrong, does the IRS define what real estate activity is to be able to be designated as a real estate professional, right?
they do, but they don't. Like with everything else. They hold you to a standard that they don't define, but they'll penalize you when you don't meet it. That's why I love tax. It's like a dance, right? I'm not a great dancer, but I'm great at taxes. So they don't really define it. Yeah.
You gotta have your niche.
I mean, real estate is a lot of fun. So they don't specifically define it. There's not going to be anything you find in the code that lays out that exact situation. So that's when consulting with, and it doesn't even have to be a CPA. So I am obviously biased because I am a CPA and I think CPAs are amazing. When it comes to tax, CPAs actually had to learn very little about tax to become a CPA. So not all CPAs specialize in tax. So let's not get hung up on the titles. You need a tax professional who specializes in real estate. because they're going to know those rules in and out. And when it comes to the IRS tax code, not everything is clearly defined. So having somebody who understands nuance and who understands how to apply intent and designated purpose can really change your tax outcome. There's a lot of gray area in the tax code, and understanding a lot of what the IRS has us look at as tax professionals is, what was your intent when you made that decision? So let's say house flips. You flip houses. Ordinarily, that's ordinary income, right? We all know that if you're flipping houses, it's self-employment income. It's subject to self-employment tax, or maybe we don't know that, but if you didn't know, you do now. It's normal transactions in the course of business. There's a lot of literature out there that says, well, hey, if you just hold those for 1 year and 1 day, now it's capital gains instead of ordinary income. Whether that's true or not depends on a lot of factors that are not clearly defined in the tax code. So you have to work with a tax pro who really understands real estate rules, how the IRS applies them, because it's not all in black and white. So if you're not currently working with a tax pro, if you're using TurboTax or Free Tax USA, I highly recommend you get a consultation, have them look over your prior year return. 9.9% out of 9.9 out of 10 of the returns that I review that were self-prepared and have rental properties or flips or whatever are usually wrong. And when I correct them, I can save you a shit ton of money. So I typically pay for myself in the services that I bring to the table, and any other tax professional who specializes in real estate that you consult with will be able to do the same. So it doesn't have to be me. Maybe you don't like my brand of attitude or atmosphere, and that's cool. I'm not for everybody. But find a tax professional who understands what you do, who understands your industry, who's got the vibe you're trying to get when you go into their office or meet with them on Zoom, and let them go through your tax situation and tell you how you should be doing it and how you can save money. Because if they're worth their salt, they'll be able to do that.
All I heard was use a tax professional and save money.
Hello.
Yeah.
Sold.
There you go.
Sold.
Yeah, I'll just add to the chorus there and just say, even for myself, as an attorney who specializes in real estate and has gone through a number of CPAs, if I'm talking to my CPA and I said, hey, why are we doing depreciation this way? And then my CPA writes back and like, oh, that's a good idea. We should do that. Yeah. I'm not a tax attorney. I'm not a CPA, and that is just by nature something that's a red flag. I mean, I highly recommend you guys call Andrea. It is, I can attest to the fact that if you get the right CPA who is very real estate specific for you guys, it can save you a lot. And I'm not just saying like whatever the cost of the CPA, the tax preparation is, a lot of money over a lot of time. Yeah. So I want to echo that and just recommend that. And again, someone who's been in and around real estate for 2 decades now, like I've known huge real estate developers who literally will employ an army of CPAs to make sure that they're getting every possible deduction.
Donald Trump.
Not who I worked for. I did not work for him.
I'm just saying,
But
that's a prime example.
He is an example of a real estate developer who,
saves a shit ton of money in taxes because the CPAs are excellent. Right. I would love to get my hands on that tax return, not because I care, but I'm just so curious.
I think it's out there. It's out there.
I want to know.
It's actually out there.
I want to learn all the secrets.
I think they released them.
So as an example, just earlier today, I'm like, John, just before I came here, I was drafting an operating agreement. Just before I came here, I was drafting a tax plan for a potential client who is now a client. He does house flipping, and tax advice for buy and holds and tax advice for house flipping is very different. I generally don't recommend to own buy and holds in an S corporation for a whole slew of reasons. I could talk all day just on that. But for flips, S corporation, if you're doing enough of them and making enough money, could make sense. So in his case, his bookkeeper came to me and said, hey, my guy needs some tax estimates. He hasn't paid any this year, so I'm coming up with tax estimates for 3rd and 4th quarters. I had to tell this 21-year-old guy who just happens to be crushing it in the flipping business that he had to make a $38,000 estimated tax payment for 3rd quarter. He calls me like, holy shit, what just happened? So we talked through it. I explained to him why that is and why it was different from his 2020 return when he had a W-2 job and didn't know anything. Now he's making all this money in this flipping business because he's just churning them like nobody's business. I don't know how in this market. As a side note, he's in Kansas, not Virginia, so that's probably how. Virginia, you ain't making any money on flips right now because you're paying a premium to get them. But in Kansas, he's making money. So I ran an analysis and compared a single member LLC versus S corporation. Just in 2021, based on just his January through August numbers, I'm going to save him $29,000 in taxes. The main strategy that I employed in this fancy tax plan was S corporation status. So having somebody who understands real estate, who understands the types of deals you're getting into, can really save you. I mean, I charged him whatever I charged him for the tax plan, but he's saving 10 times that on taxes just this year. He's probably going to replicate that tax savings next year, the year after, and so on. So if you haven't consulted with a pro, highly recommend that you do. Not everyone who meets with me decides to work with me, and that's great. I try to leave every consultation with having imparted some kind of wisdom, whether they follow my advice or not. But if you haven't already talked to somebody, I highly recommend you do it because it will pay off.
I will also echo that. And just to again, tag on the back of that, and Steve and I were just talking, but you have to realize that even if you're an LLC, you can elect to be taxed as an S corporation.
Yeah, S corp is not a legal entity type. It's a tax-only election.
Right. So there are corporations in Virginia, and there are LLCs in Virginia, and there are some other business entities. When you're a corporation, then you elect to either be a C corp or an S corp. If you're an LLC, you can elect to be taxed as an S corp. And Andrea is the person who will tell you whether that's a wise idea or not.
Yep.
Right. But even if you're an LLC, you can elect to be taxed as an S corp, which is helpful. Again, why LLCs are great, because they're so flexible in their structure and the ability to basically adapt to whatever your needs are in that regard. So
one thing it's actually a question I'm going to ask the attorneys because I know the answer because I've asked it before. So it's a setup.
So
And
she's
I'll
putting us
tell
on
you
the
why
spot.
in a minute. So let's say you have a husband and wife that want to form an LLC and own properties. Do you recommend that the husband and wife are both on the LLC, making it a multi-member LLC, which is taxed as a partnership, whole separate set of tax rules, a whole separate tax return, a lot of additional compliance costs? If after they talk to me and I say, yo, y'all don't really need to be a multi-member LLC, let's make the husband or the wife the only member, the sole member, so it's a single member LLC, how could that husband and wife protect the other spouse's interest in that rental property if they're not both on the LLC? What other legal vehicles might work to convey that property to the spouse?
I feel like that's a question you've asked Steve before.
I have.
And
We've had a
I
discussion.
don't give
or
legal
two.
advice, but I like to know.
I would love. I will let Steve answer
Okay,
that
so
question.
yeah, so it depends.
There it is. Answer
The
every
answer to
question
everything.
lawyer.
It depends. And if you know, I said this before, if you have 50 attorneys in a room, you ask a question, you get 50 different opinions.
Same with CPAs.
So it depends on your situation, right? Why are you getting into this investment in the first place? Is it your deal? Is it her deal? Is it something you're doing together? And as much as I'm not a marriage counselor, you got to consider those things. You know, is it going to hurt some feel goods if you're the only one that's on the LLC? Is it going to make your marriage stronger if you're both there?
Well, more than 50% of marriages end in divorce.
Well,
I don't know nothing about that.
Well,
right. So businesses
really?
businesses are a lot like marriages. So businesses are a lot like marriages. How many of us get married thinking we're going to get divorced? You know,
You went into it that way? Okay.
After the first
does
one, yes.
My bad.
after the third
After
one.
the first one.
That sounds
So-
like a tax strategy, but anyway.
So nobody goes into business with a partner thinking it's going to explode either, right? So some things to consider. If you do go into business with a partner, one of you has to have 51% control. 50-50 does not work. Things start going bad, things start going worse. You're now deadlocked. You can't make a decision because you don't have a majority vote. Well, and even if your operating agreement says majority or unanimous vote to making those things, you can't do those if you're 50-50. So right off the bat, I'm going to recommend, 5149.
Can I amend that real quick?
Please, please.
Just realize too, the great thing about LLCs and operating agreements, you can bifurcate between ownership interest, which is like distribution
And
interest, and
managerial
voting
control.
interest.
Right.
So you can have a 5149 in voting interest, so that someone has a controlling voting interest, but you still end up 50-50 in the money in the
Right.
distribution. So just quick side note. Go ahead. please,
Absolutely
Steve,
true,
please.
and I appreciate you bringing that up.
Yeah.
Another point is how the courts will handle succession planning. If you're a single member LLC and you die, how is the court going to handle that entity? Is it going to dissolve it because the single member is gone? Are they going to pass on the monetary value of that company to the legal heirs? Are they going to pass on the monetary value as well as the voting value of that LLC to the legal heirs? What happens to the assets that are sitting in that LLC as a single member LLC? Have you accounted for that in your will? Do you have a succession plan in place should something happen to you? These are all things you need to consider when you're looking at, do I put my spouse or my partner or someone else on this LLC? Is the succession planning? What happens if, you step across the street and you get hit by the bus? I would be happy to answer those in a consultation when we understand your situations more intimately.
And when you form the LLC in the front end, also important, I can't tell you if there's no language in your operating agreement which discusses specifically if it ends up as a single member, which is an individual, because companies can be members of LLCs. Companies can own companies, right, with LLCs, not necessarily with corporations. We won't get into that. But you could have an LLC that owns an LLC that owns an LLC, and you get into the Russian doll situation, right? But the point is, ultimately, it always comes back to an individual, like an individual with ownership. If you have a single member LLC with an individual ownership and that person dies, and you don't have anything in the operating agreement that deals with that, you get into a world of mess with, especially even if you have a will. I mean, you absolutely want a will, but the operating agreement can say, hey, in the event that this ends up as a single member LLC, whether it starts that way or ends that way, and that individual dies, the voting interest, the membership interest, all, like, you can set it up so that there is a succession plan primarily in the operating agreement, which is very important, because otherwise you deal with something called dissociation under the Virginia Code, and you don't want to be there. That's when you basically cease being a member and having member rights. And the LLC and whatever it owns and whatever money it has can be in total limbo. And there are some very basic provisions inside of the operating agreements that can be essential for that kind of situation. So
and if the operating agreement is silent on a topic, then the statute, the limited liability statute in Virginia, will be supplemented in any of those gaps. So if it's silent on that specific issue, well, the judges are now going to turn to the statute and say, how does the state say we're supposed to handle this?
right, statute being the law.
And it may or may not be what you guys want to happen.
Right. It's just like if, real quick, just as an example, that if you don't have a will and you die in Virginia, the state determines where all your stuff goes. There's there's tons of law. There's a whole different scenario. There's a whole complex scenario that if you die and you don't have a will, the state has all these weird permutations. I say weird, but they've taken a lot of time to figure it out because a lot of people die without a will. But they determine where all your stuff goes. You don't want to be in that situation. You want to have a control over not only your stuff, but frankly, where your stuff goes if you were to pass. I mean, that goes with the LLC too.
And so the operating.
Oh, we got a mic coming back to you. Hold on.
So, forming a single member LLC, like all these things that you guys were talking about, seems that it kind of gets deeper and deeper. So you obviously need you guys' professional help. But are there things that we can do to kind of prep before we even get to the point of bringing our LLC to you to kind of get more professional advice as far as formation? Or should I just go from ground zero and be like, hey, I want to start this LLC?
Help me.
Honestly, you can come from any place. I mean, it's helpful to know what your purpose is. It's helpful to know if you've thought long term about where you want to be ultimately. You know, you typically want to start with the end in mind. But if you're just like, I just want to buy and holds, or I just want to flip properties, or I want to wholesale, or whatever the case may be, the purpose of what you're doing and forming is essential. And then thinking through, like, well, what if this actually is incredibly successful and takes off? What does that mean? Where do I want to be with it? You know, it's helpful. Listen, I've done 3-page operating agreements. I've seen 102-page operating agreements, and every single thing in between. And there are certain complexities that are overkill. I will say our profession loves to make things more complicated.
To validate itself.
Yeah, it's an inferiority complex, I'm sure, in the legal profession. Lawyers, if they get a document that's perfectly drafted, they will always make a change to justify their existence.
That's a true story.
Unfortunately.
You need to own everything in a trust.
I got my law degree, and I passed the bar for a reason. And even if it isn't necessary,
On the 7th
y'all
try.
gonna feel it. Y'all gonna feel it. No, I mean, but my point being, you want to, if you have an end in mind, if you have details, if you have specifics, or if you have questions, but you don't have to have those things. It's partially our job to be able to say, have you thought through this? Have you thought through, you know, A, B, C, X, Y, Z? Like, and we're not going to know every question to ask you because we don't know every single individual. But when it comes to the law, there's a lot of well-worn paths.
So as agents, you know, sometimes it just cuts out a lot for clients that come to us already prepared. Something that they can go off of, you know?
Yeah.
So that's why I'm kind of thinking is it the same thing?
Well,
Where, you know, I mean, of course, you
Yeah.
can take somebody in, you think they're here.
Sometimes people don't know what to ask.
Right.
We
So
get that a lot on the tax side. Like, I don't know what I don't know, so I don't know what questions to ask, which
That's-
is where working with attorney can help. If you go to LegalZoom, they have a set number of questions, and anything outside of that is it. I say LegalZoom, it could be any online. Let me talk into the microphone really, really loudly.
I don't want to be bashing on LegalZoom
I
because
do.
they've got a
Don't
decent
do it.
product.
Don't do it.
Disclaimer. Just to build on that a little bit, come as prepared as you possibly can, understanding that the
They're gonna
process is
ask
going to
you.
be a learning process for both parties, right?
Yeah.
So when I do an operating agreement, I'll do a draft based off that initial interview. So we're going to ask you, what do you want to have happen when you die? Is your first legal heir a 6-year-old kid?
Right.
Is your 25-year-old first legal heir a crack addict? Do you trust to leave a $1.2 million business to your first legal heir? There are several things we're going to talk about, and we'll craft that document, and then I'll send it to you with a great big old watermark on it that says draft. And and I'm going to say, look at this, read it over, and tell me what's wrong, tell me what needs to be changed, and we start that dialogue.
Yeah.
And it should be a back and forth until we get it to where it's, 1, it meets all your needs. 2, it's something you're actually going to follow. 3, it's flexible enough that when your situation changes, you can change with some resolutions, you can change with some minutes, you can change how it operates without necessarily coming back and having the whole thing rewritten.
And or your tax pro understands your operating agreement.
Yep.
Because the operating agreement not only affects how you legally run your business, it can affect the tax side as well. So I had a husband and wife come to me not that long ago. It's a plumbing company. They formed a multi-member LLC without consulting a tax professional. Wife is not active in the business. The husband was a W-2 employee at a plumbing company, started it. They put them both on the LLC. Don't advise that. They had an operating agreement from online operating agreement company. It said what Steve said earlier, which was that they were going to notify themselves of an annual meeting by certified mail. They hadn't done that. So even as a non-attorney, I can pierce their corporate veil. And it has some tax implications. So when you are working with an attorney, it's not a terrible idea to loop in a tax pro. We've done small business workshops and we call it setting your bail team. When you're starting a business, whether it's real estate or otherwise, you need to set bail. Banker, accountant, insurance, and lawyer. Set your bail team, get them talking to each other, get them all on the same page. Bail team. because we can help you avoid some of the pitfalls. In the case of that couple, they really didn't need to be a multi-member LLC. They didn't need to incur the cost of bookkeeping for a partnership, filing a partnership tax return every year, doing all these other things that could have just been a single member LLC, because they didn't understand the difference. They didn't understand the other ways that their attorney could help them make sure the wife took over the company if something happened to him that was outside of having her on the LLC. So they probably in the course of their business would have paid less in legal fees if they had consulted with an attorney than they will pay in having to file a partnership tax return for $1,000 every year. So penny wise, pound foolish.
Yeah.
Hello.
Yeah. Listen,
I've got a.
I sell nothing. You can consult with whoever you want.
Yeah. So one of the first ones is Andrea. Do you do any accounting in Texas? Can you do anything in Texas? I don't know what the laws are.
In Texas?
Yes.
Yeah. So I am able to prepare tax returns and offer accounting advice in every state. Not all state has income taxes, which makes my job easier because then it's just accounting. But yes.
Okay. Yeah.
So if
Vanessa,
you
we'll
want to
get you
state
her
no income
information.
tax, Texas is one of them.
And then the next question is, what are the LLC or S Corp requirements in Virginia for small businesses, specifically home-based independent travel business? And
I guess I'm not sure that I understand what what do they mean by requirements?
I don't know. They didn't elaborate. Andrea Walker, if you're still watching / listening, if you could give us a little bit more information. But if I had to guess, just like basic legal and accounting requirements.
So I can tell you based on the questions I get, if you have somebody who's operating out of their house, so there's not a physical office where somebody could trip on the curb and bust their face on the front door, do you recommend forming an LLC? Home-based business, no employees, very limited potential for slips, trips, and falls.
But we're talking,
Yeah.
So like a
Yes,
virtual.
but we're talking real estate still, right?
Nope. So in this
No.
case, this person has a travel business, I think she said, right? So think like Suzanne. So home-based business, people don't come to the house.
Listen, again, to be a lawyer about it, absolutely. Any business can get sued.
Yeah.
If you're going to get sued, you want to have as much liability protection as possible. And so, yes, I mean you might be able to streamline certain elements of it in some of the accounting and some of the, not the corporate governance side of things, not running the company, but even if you're running a home-based business where you're providing a service, again, I think, and Steve's a litigator. Listen, I'm more of the transactional guy. I set up the LLCs. I help deals get done. He'll come and like wreck shop if needed. When it comes to law, I'm more of a lover than a fighter, to be totally honest. I'll get in there when I need to, but I got other litigators in my firm that I'll let the dogs loose when I need to. But the point being is you're always protecting against your liability in any situation, and you're trying to think ahead. And so even a home-based business where you're not inviting clients there, if you even have any business has a potential to get sued. Like if you make a wrong turn, or if you end up booking someone to Kabul right now, or Kabul, instead of I don't know, Greece, and they end up in the Taliban's hands, like you could have liability for that. You know what I mean? That's.
So I think that's
or you sign up for travel insurance and for some reason the policy didn't get issued.
Yeah.
You took off and then your bags are in Greece, you're in France.
More realistic
and now you're sick and you can't travel. There's a million things. You'd be surprised what people sue people for.
And then remember, S Corporation is not a legal entity. So for that question, the S Corp advice would be highly dependent on their income. As a very general rule, remember back to the disclaimer that I wrote out to make Steve proud because he is my attorney. As a general rule, post Tax Cuts and Jobs Act, because before that the advice was very different. So 2018 and later, as a general rule, I look for net income in a business, whether it's real estate or anything else. I look for net income to be at least $50,000. And net income is gross income minus all of your expenses. So I want that net amount to be at least $50,000 before I will even waste my time running the analysis of S Corporation or not. Because I know if it's under 50, it's not going to be worth it. Between the compliance costs, tax filing, and whatever, it's going to break even on tax savings with additional costs. So General rule of thumb, very general. I'll repeat the disclaimer if I need to. 50K and up in net income before you even waste my time booking an appointment to talk about S Corp.
So I think this is
it's all about her time, not
This
yours.
is a good transition, guys,
Yeah.
for online and here in the group to go ahead and let Steve do his so we can stay on track for 9 o'clock. I think this is a good panel, guys. What do you think so far? I mean, you've got like, hey, set it up right. You've got CPA being like, okay, let's do this.
I can talk about this stuff.
And you got
all
litigation
freaking
being
day.
like, man, I'm gonna jack you up. I love it. I love it. So I think this is a really good panel, but I really want Steve to have his time. So let's go ahead and move towards that and let you guys go. And then that leaves us that window of time to ask questions online as well as here. Okay.
All right, so for the most part, I don't have that much to add. And what I mean by that is I think they've covered quite a bit. What I will say is just piggybacking on the last question that we had from online, for the seminars that Andrew was talking about, the Set Your Bail team, the banker, the accountant, insurance and lawyer, we used to put together also, I had some statistics, and I'm going to lie to you right now because I don't have the exact numbers off the top of my head, but it was something like, give or take, right? Standard deviations and all that. It's something like 97%, I want to say, of all companies from the time they're formed till the time they're either dissolved or sold or what have you, get sued or sue, are involved in some sort of litigation. 34%, again, I think I might be lying to you, it's somewhere in there though. 34% in any given year are involved in litigation. You are going to get sued.
Forced.
Don't get screwed. So don't.
I'm gonna make that either a T-shirt or a koozie. I'm not sure which one.
If the glove don't fit.
Bumper sticker.
You must have quit. Yep.
So when in doubt, organize a company, limit your liability.
When in doubt, lawyer it out. Is that a thing? Like,
We'll take that.
I just made your tagline. Check out Archangel Law Group after tomorrow. That'll be the new tagline.
So I guess the best thing right now would be, what are some of your questions? I can tell you right now, some of the most litigation that we're facing with real estate is, a partition suit, which means you have multiple owners of a property. For one reason or another, they're not sure how to get rid of it. One owner wants to get rid of it. One owner wants to hold it, et cetera, et cetera. How do you dissolve that or break that up? We have the slip and falls. We have the, negligence of a tenant, for instance, that caused damage to the house, to the property. We have holdover tenants. Of course, we have the whole
Eviction.
moratorium on
Moratorium.
evictions, which on the federal level, by the way, this week the Supreme Court ruled that was unconstitutional. The
I saw
CDC
that on the
extension.
Archangel Law Group.
However, there's still the People's Republic of Virginia to deal with, and they have a moratorium. And the moratorium, incidentally, was extended through the budget of all things.
June 30th, 2022.
So they've extended the moratorium based on non-payment of rent, and they passed it affecting the VRLTA through the budget being passed, which I thought was kind of sneaky.
Yeah, that's how
On
they
August
do.
10th. So now there are some additional notice requirements, et cetera, to get rid of tenants for that reason.
So you need an attorney to help you find
Yeah,
other reasons
we'll find
to
another
evict
reason to
and
get them
non-payment
out
of
for
rent.
breaching the lease.
Hello. This
So
is where
another-
having a legit lease agreement comes in handy, right? Let's not legal zoom that.
Another area that we're litigating a lot lately are, especially in this market, is all the, as hot as everybody wants to be flipping things, is the fraudulent rehab that's going on. The substandard work. The trying to make a garage a bedroom and not getting permits. The throwing on an addition to the house with a bathroom that the plumbing just goes out to the yard.
That's totally
You laugh,
legit.
it's a real thing. The foundation that's sinking, so the sewage piping actually has to go uphill to drain. And the landlord or the owner saying, I didn't know anything about it, but the stamp on the damn pipe shows that it was manufactured after he was an owner. Those kinds of things are what we're running into. So a lot of fraud on the flip side.
Poop doesn't run uphill?
Apparently, but it will come through the walls and the ceiling if it impacts. So those are the kinds of things we're seeing from a litigation standpoint. And usually when we're dealing with this, it comes all back to what John's talking about. Who are we suing and why, right? And what are the remedies we're looking for? one of the most powerful tools we have is what's called the VCPA, the Virginia Consumer Protection Act. And it allows for, if it meets certain criteria and certain prohibited actions take place, for us not just to get the damages for the house that are done, but also get what are called treble damages. So take those damages, $100,000 to get this thing repaired, times 3. So now $300,000 and attorney's fees. Typically, they won't do punitive damages on top of the trebles, but you could get either or. There are various different ways that any creative litigator could come up with for making a case for getting your LLCs or your protection in place. I really think the best, probably the best
Can
thing
you
is
explain that treble damage?
treble. So treble meaning 3, right? 3 times.
Triple.
Yeah.
Treble
it's a-
equals triple.
Right.
All of a sudden, lawyers are musicians.
All of a sudden,
Yeah.
I'm all
All
about the
about
bass.
Also, there are tax implications
Yes, treble.
to
that
damages
bass.
that
All
are
that bass,
awarded
yes,
depending
treble.
on what they're called. So punitive damages could or could not be taxed. So sometimes that terminology matters. So looping in your accountant with your attorney to get those requests labeled correctly could matter. Just saying.
Yeah.
So I think probably the best thing is, what are your questions as far as what's been covered so far? Yes, sir.
I like it.
Oh.
So at the risk of outing myself in front of my lender over here, when you say you live in a property for a year or two and you decide, okay, I'm going to move on, it's going to be a rental property, what's the best, safest way to move it into an LLC to get that protection, maybe without, I don't know, refinancing to twice the interest rate?
So you're worried about the acceleration clause.
Can they take that property back?
So you're saying you own a property in your own name, right? And then you want to transfer it, figure out the way to transfer it into LLC.
And you don't want the mortgage lender to call the loan due.
And
Correct.
You're worried about the lender. All right. I will give you the answer that I've given many, many times. In that you can, if you deed the property into an LLC and you continue paying the mortgage, the lender has a right. So under every single templated deed of trust, and the deed of trust is the document the lender records at the courthouse behind your deed, securing the lender's rights on the public records for them to be able to foreclose if you don't pay the mortgage. In that deed of trust, every deed of trust I think I've ever seen, there is, people know it as a due on sale clause. Sometimes, yes, but really it's a transfer of interest clause, which says if you transfer any interest in this property or any portion of the interest in this property to someone else, that is considered a default under the loan, and we have the right to call the note, right? If you don't cure it. And cure it is mean fix it. So the lender would have a right, if you said, I'm going to now deed this property into an LLC, the lender would have a right under their documents, presuming that they have a standard deed of trust, to say, hey, you violated your loan, you violated the deed of trust, you have to fix this or else we can call the note due. To date, I have never seen a lender call a note as long as you're paying it on time.
They don't want your house.
Speak to that for a hot second.
Side note though, as a side note to that, some states have a transfer tax. Some states tax a transfer from personal to an LLC.
Well, Virginia does if. So there are provisions in the code of Virginia that if you are transferring it from an individual or individuals into a LLC or a company or a corporation, as long as the individuals hold at least 50% of the right to receive distributions from that company, then it is not taxed, right? That transfer is not taxed, right? Or opposite way, if you're going from an LLC to an individual, as long as the property is going to the individual, I'm talking about the Virginia code right now, not the IRS code, but the Virginia code, as long as the property is going to an individual that is entitled to receive at least 50% of the distribution from that LLC, it is not taxed. It's a deed of gift or a deed of transfer. There are specific exemptions there. So what I suggest is if you own a property that you decide to then rent, put it in the LLC because it's a risk-benefit analysis. The risk of a lender calling a note due to the transfer of title is far less than I've found in my personal experience for about 20 years being in real estate than the risk of someone suing you on that property and the owner of that property. I have yet to see a lender call a note due on that specifically without there are other circumstances. I've seen once or twice where there's something else weird and funky going on, where a lender's alerted, there's maybe a subject to deal and something happens, and that's not great. But in general, you own it, you want to put in your LLC, that's a far better protection of your liability. And my remedy, if that were to ever happen, right, if the lender says, hey, I don't like this, you put this in an LLC, then I would transfer it back to the individual, right? And say, cured, right? Cured. And then continue to paying the mortgage and then look for the first opportunity potentially to go back to the LLC. Frankly, because the
but
liability.
let's be very specific. You're in a world of 11 million defaulted mortgages. Who's going down to the courthouse being like, who's transferring shit?
Yeah.
And from a tax
But
standpoint,
at the same time, I've dealt with a couple of these where we've done the transfer, the deed of gift, and we've actually written letters to the mortgage company and said, this is what we're doing. And we provided the LLC documents. We've shown that the person that they actually, the individual lender is actually going to be responsible and controlling of this LLC, et cetera, and saying that the LLC will continue to make payments, whatever kind of warm fuzzies they need. I have yet to see a mortgage company say, nope, we're going to do the acceleration clause or the transfer clause and not do it. And that way, you basically get some sort of a written response from them saying, yeah, go ahead.
That's a good protection. Frankly, it costs way more for a lender to foreclose on you.
And they don't want to be owning property.
And they're not in the business of owning real estate. They only own real estate to protect their financial interests of the money they lend out.
and from a tax standpoint, there's no difference. If you're a single member LLC and you own it personally, it reports the same exact way on your tax return. So there's no hitch in your giddy up on the tax side.
Huge difference on the legal liability side. No difference on the tax side. So when it comes to owning rental properties, I highly recommend, and again, unfortunately, lawyers are their own work. They take their own advice way less than you think they would. Lawyers are the worst. And it's the same thing. When you see a doctor smoking and eating a cheeseburger and then going in as a cardiologist, they're like, oh, well, that's, but my point being, like, the risk on the legal liability side, from my viewpoint, is far greater. Does the lender have the right to call the note due under the loan documents? Yes, technically. Have I ever seen it happen in a typical situation outside of something else weird going on? I've never seen that happen as of yet. Doesn't mean it can't. Not saying the lenders don't have the rights. I'm just saying they typically don't. They typically care if the mortgage is getting paid.
And just to go back on that, because you were talking to sub 2 stuff, right?
Yep.
So even on the documentation of the HUD, it says this is being transferred subject to the existing mortgage. There's notification of it, right? So it's not like, so there's notification on the HUD saying this was transferred subject to the existing mortgage. So there is paperwork showing it, but we're going back to, like, who's notifying the bank of, like, going down to the record room and pulling records being like, who transferred out of this name to this LLC? Let's be real.
The big thing is, if you're doing subject to deals, and I do a fair amount of those for clients, you got to be really careful. You have to be, I don't work with people doing subject to deals that are not upfront with their clients. I've fired clients before because they were, and unfortunately, there have been times when I found out after the fact where a seller wasn't clear that their mortgage was staying on the property. And I've had to have that very difficult conversation, which I don't like having. And now for us as a firm, there are very serious disclosures. I don't care what the client wants. If they get to the table, they're signing the disclosure, I understand the mortgage is staying in place. You need to be upfront. And I'm always going to insist and ensure, frankly, that if you're doing deals, you've got to be upfront with your sellers. They have to understand, to the best degree possible, they understand what they're getting into, right? On a subject to deal. And that's a whole different night right there. But all that being said, it's important to understand the lenders really care about the mortgage payment. If they're getting paid,
he's serious, because in tax and law, there's never, always, and never. Right? Nothing is ever, always, and never. So if he's saying never, 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 he freaking means it.
Yeah.
Just do that.
That's right. Thank you.
So Steve, you feel like you got out what you got?
Couple questions.
Yes. Here we go.
Hold on one sec.
All right, so it sounds like you recommend actually transferring the property and not just the so-called management responsibilities to the LLC.
Well, if you only transfer the management responsibility, Steve can talk. If you only transfer the management responsibilities, you don't limit any liability.
We're
If
still
someone-
coming after your asset.
If someone slips and falls and you own it personally and your LLC is managing it, they're not suing the LLC. They're suing the owner of the property,
Not the property manager. at this
not the
point.
property manager. I mean, they might include the property manager in there, but the end of the day, whoever has title to the property is the one that's liable for what happens on the property.
That answer your
Okay,
question?
yes.
Yeah.
Yep.
Clear as day.
As a matter of fact, like when we were talking about like VRLTA, the Virginia Landlord Tenant Act, the leases are between the tenant and the landowner, not the property manager. So there are a lot of times where a property manager will try to assert the rights of the landowner, and as long as they're acting as their agent, they can do that. But I have a case right now where the property manager was actually fired, and they're still trying to do walkthrough, move out inspections and all kinds of crap right now. And it's the management side is just of no interest to us.
Yeah.
At that point, from the liability standpoint.
So, a couple other questions.
Any more questions online and any more questions here?
So from a LLC incorporation standpoint, when you do the articles of incorporation, how specific would you recommend things to be? So for example, say you're a realtor, but you also invest in real estate. Would it be better to have two LLCs, one for the real estate assets and one for the realtor? Or is it okay to have to bleed that line because they're both real estate specific?
Well,
I have a tax answer. I'll go after him.
Well, I want Steve to answer that because he's a litigator and he's a stuff in court. In general, I will say it depends, which is the answer to every question. But predominantly, it depends on what kind of investment you're doing. If you're doing buy and hold real estate and you're also a real estate agent, I would not run those businesses under the same LLC. If you're doing a flipping business, which flips and has money, and that money gets distributed out usually pretty quickly, on a monthly or at least a quarterly basis, that may be okay, but you really, again, it comes down to liability. If someone sues you in one business and you run everything under one, they can get everything underneath it if they win. That's really what it comes down to.
I would absolutely agree with that. As a matter of fact, so let me ask you this: on your if there is such a thing, on your standard flip, how much money do you stand to make? I don't even really expect the answer. But think about this: if I do an LLC for you, I'm charging you $100 for. Well, the state's charging $100 for the SEC. I'll do your operating agreement for maybe $650, $750, whatever it is, right? We'll get the operating agreement in place for you, and you're off and running, and you're protected. What does that look like compared to the kind of profit you're going to be making in a real estate transaction versus what kind of protection is that going to be giving you in a real estate transaction? So I think your question though was you mentioned the articles of incorporation, and just splitting hairs here, it's actually the articles of organization with an LLC. And then I think you're talking about the operating agreement or the bylaws in terms of a corporation as opposed to the articles, how they actually govern how you run those companies. From a theoretical standpoint, you could have the same operating agreement and several different product lines, if you will, going through there, and you could operate each one of those product lines in the same way. So you could have that individual single operating agreement do that. But to John's point, if you have, for instance, that slip and fall in property number one, and you also have investment properties in a product line under the same LLC, and that slip and fall is for a $3 million injury, maybe it's an accidental death, we don't know, and the house is worth $350,000, where's the rest of that judgment going to come out of? It's going to come out of your investments. And we're going to come after everything that's under that LLC.
Including your real estate agent commissions, which
yeah.
are probably more than you're making on your buy and holds or even your flips.
Yep. So I would say every single property, if you look at it from an ROI perspective, every property should have its own LLC and should be operated independently.
From a
'Cause
tax standpoint.
you don't want to put, or a business trust. You don't want to have that exposure to expose many of your other properties to the risk of one.
Yeah. To amplify that, I've got clients who make a business decision and they'll say, well, I'll have up to so many properties in any one LLC. I mean, there is, again, it kind of depends on how big you are. If you have 25 individual properties, you know, if you have 25 LLCs, 25 tax returns, and you're going to do, and Andrea can talk to this, for the most part, you're going to do a tax return for each LLC, depending on a few factors she can talk to. But you're going to do 25 tax returns, 25 bank accounts. I mean, there's an administrative burden that gets in there. Yeah. So there are clients that do a bit of a cost benefit analysis, saying, you know what, I'm going to have only up to X number of properties in any one LLC or X number of equity in any one LLC, right? And that's a business decision, like balance against a liability risk position, right? And you just have to think, like, if I have a 14-unit apartment complex, I'm gonna want one LLC for that and nothing else in there. If I have a duplex and one single-family home and one townhouse, you know, for liability, are you safest having each one in their own LLC? Yeah, for liability, 100%, right? 100%. But again, there is a practical consideration that people take into saying, you know what, I don't need. I'm a person. I have a W-2. I have a couple of real estate investments. I'm trying to keep up with multiple bank accounts.
And what are the chances I'm actually going to get sued on one of those?
Right.
In that risk analysis.
Right. Exactly. So I don't contradict what Steve recommends in saying, you know, having every single property in LLC. Like, people can do that. That's very, very risk averse, and that's the safest way to be. But there is that balance, and that ultimately comes down to your kind of risk assessment when it comes to your investment strategy too. Some people are willing to take a little more risk than others. So,
and from a tax standpoint, I would be comfortable recommending for a real estate agent to lump their real estate agent commissions and flips in the same LLC from a tax standpoint, not a legal standpoint. Remember, two different areas here, because they're all going to be ordinary income. But buy and holds are a different matter. With real estate agent and flip houses, we could look at the income and say, all right, you really need to be an S corporation. There's no negative impact, because when you flip houses, the houses are inventory. They're not assets on your balance sheet. You're not depreciating them. They're inventory. Buy and holds are not inventory. They're assets on your balance sheet. They're appreciating assets. I don't want you owning appreciating assets in your S corporation, and there's a whole slew of reasons, but a couple of the quick, just initial questions are, what happens if you sell your business? Your S corporation owns that house. So when you sell your business, you're selling that house too. It's gone. What happens if you die? Whoever gets your S corporation when you die gets that house. It's at the same basis. It's at the same everything. Whereas if you own it separately, when you die, you get a step up in basis, assuming the proposed tax law changes don't go into effect. One of the proposed changes is to eliminate step up in basis, which would be horrible for everybody. Let's ignore that. So flips and real estate agent income, okay to have in the same one from a tax standpoint, but buy and holds you're going to want in a separate entity for tax purposes. Again, different than legal advice, but from a tax perspective.
Is there a time period per se that differentiates the difference between
So this is one of those areas where there's no bright line test in the tax law. IRS doesn't say your flip is automatically ordinary income. There's a lot of literature out there that says even if you flip houses, as long as you own it for more than a year, you can treat it as capital gains. Whether that's true or not depends on a lot of factors, and this is where having a tax professional who understands real estate, because there's no black and white IRS code that says, yes, if you own it 1 year and 1 day, it's automatically capital gains, even if it was a flip. So it comes down to intent. If your intent is to have a business where you flip houses, as a tax professional, I'm going to treat that as ordinary income. If you're like, I'm going to try this once and see how it goes, I may or may not do it again. It took you 18 months to flip that damn thing because you didn't know what you were doing. We might be able to treat it as capital gains. We might not. So it depends.
Guys.
There it is.
So I'm going to step in here because it's 9 o'clock and I see like everybody's glass is empty here.
Everyone's having a good time.
So this was awesome.
Oh, snap.
We can I say let's grab some beers, let's come back for some Q&A if everyone's down for hanging out for a little bit.
I got to pee, so I'd like to go do that.
This was awesome. A lot of killer takeaways here, guys.
Be
This
real.
is I hope
I
you guys
forgot to
got
mute
some good
before I
stuff.
said that, but it's
Bail,
fine.
which was have a banker, accountant, insurance, and a lawyer. That one's
Bail
going to
team.
be there. That's
Set your
killer.
bail. They'll keep you out of jail.
John was talking about managing that risk and cost
benefit analysis.
Cost benefit analysis.
Which,
I
as an
think
accountant, that's like
crucial.
my favorite term.
Yeah, I mean, everybody in this group, and this group rotates a lot. People have one property. People have 100 properties. It's going to be completely different. Manage that for
Definitely.
yourself. And it just some really good stuff, guys. Thank you all so much for coming out. Super beneficial. I feel like I think there's definitely a bunch of us who could just keep throwing questions at you guys.
Dude, I could do this all day, every day. We could do a whole week-long seminar on this. Let's go. Hey.
Let's do it.
We
Let's
do
do
part
it.
two.
That makes one of us.
So guys, thank y'all. We're gonna round it up, and then we'll come back. Let's get some beers, and then come back and do some more Q&A. Sign the sign-in sheet. Join the Facebook group. Come back again next month. We're gonna do house hacking. We're probably gonna be talking about rehab loans to do house hacking. So yeah, guys, come back. Join us, Hopportunity Investors. Thank y'all for coming out. Thanks, guys.